And my company is Traicon. And I've been a small business advisor and consultant for over 20 years now. I started in a position similar to Brina and with a small business office, and from there expanded working with self-employment programs across Ontario, doing training for the self-employment program that used to be for the self-employment benefit program, and also Ontario Works self-employment program. So I've been doing a lot of training over the years, and this is one of the webinars that we found that people are very interested in, because you do your books for the year, but then what do I do with the information afterwards, and how do I provide Revenue Canada with the information regarding my business so I can report my income and claim my expenses. So we're going to be going over that today. And Brina, did you want to say a little bit about your organization and what it is you do, or did you want to do that at the end?
Yeah, we can just do that at the end and talk more about supports. But if you just want to go right ahead into the presentation, that'd be awesome.
Okay, so what I do is I stop my video just so the presentation comes across clear, and I'll go in to share my screen. So I've pulled open the chat on my computer, so if anybody has any questions, you can put them in the chat, and I know that Brina is also monitoring the chat, so hopefully if you do have any questions, we'll be able to get to them very quickly. So we'll just start by talking about the income tax preparation for sole proprietors and partnerships. I do want to give a bit of a disclaimer because I am not an accountant. So the information in this webinar is intended solely for demonstration purposes. The user accepts full responsibility for its application. While we take every precaution to ensure that the content of this webinar is both current and accurate, errors can occur. The information contained in this webinar is general in nature and should not be considered to be legal, tax, accounting, consulting, or any other professional advice. In all cases, you should consult with a professional advisor familiar with your particular factual situation for advice concerning specific matters before making any decisions. So what that basically means is I'm not an accountant. If you have accounting questions that are very specific to your particular business, you need to speak to an accountant. Quite often, accountants will provide you a free 15-minute consultation or Q&A, and organizations such as the Small Business Office usually have people that they can refer you to. So if you have any particular questions that I can't answer, or if I think you should speak to an accountant, I will definitely advise you to do that. So again, this workshop is general. We are going to be looking at the form that was provided you, T2125E 21. That is the latest statement of business or professional activities, and that's what we'll be covering today. So again, here's the disclaimer, just so when I do share the slides with Brina and she forwards them to you, you can see that disclaimer yourself. So we are going to be looking at reporting business income, reporting cost of goods sold, reporting business expenses, and for those of you who are using your home to run your business at this time, you can claim business use of home expenses. We'll also show you how to calculate capital cost allowances. So these are items that usually have a purchase price of $500 or more, and how to calculate your motor vehicle expenses. So I'm just going to do a quick poll here just to see what type of businesses we have in the room. So the first poll is if you're a sole proprietor or a partnership, if you could let me know. Okay, so we've got mostly sole proprietorships and some partnerships, so I will definitely go into that information with regards to partnerships. Sometimes we don't have partnerships, so I don't always include that. The next area we're going to look at is just to determine your source of income. So source of income, you'll either be a business where you offer a product, service, or you're in the trades or manufacturing, possibly have daycare or are on commission sales, for example, real estate agents. Professionals would be medical doctors, dentists, lawyers, accountants, veterinarians, chiropractors, those sorts of business. And you'll notice they both use the form T2125, which is the form we will be going over today. If you're in farming or in fishing, there is a different form to fill in because those professions and sources of income have different expense categories which are on the form, but the form that we're going to go over today will answer all your questions. So again, I just want to do another little poll just to see where you are in business. So let me just go to the next poll. Okay, so could you let me know if you are classified as a business, if you're classified as a professional, farming, or fishing, please? Oh, good. Okay, we've got some professionals, we've got some farming. So those of you who are in farming, I will share the statement of business and professional activities for farming. I just want to let you know with regards to income, when we do it for business and professional, it is very specific, it's general. With regards to farming, they want to know what area your income comes in. So for example, is it from wheat, oats, barley, grain? So they break it down, tobacco, if it's livestock sold, milk, cream, eggs, other commodities. So where you record your income is going to be a little bit different. Plus, you'll have a few other expense categories that businesses and professionals don't have, that you'll be able to see that on the form. So if you wanted to quickly take a look at that form and download it, if you go to Google, and maybe Brina, you could go there and share this in the chat. The form that you're looking for is T2125E Form. So I'll just put that in the chat just so Brina can take a look, because those of you who are in farming might want to take a look at that. So Brina, I'm just going to put the form in there if you wouldn't mind looking it up and posting a link to it. That would be great. Okay, real estate agent is considered professional because you, I believe, get your earnings or your revenues through commission sales. So the form T2125 would work for you. So just so you can see, we have 3 people that classify themselves as businesses, 2 that classify as professionals, and 2 in farming. So that is very interesting to know. I haven't had any farming people in the group before, but the form, while it is ever so slightly different in how you will claim your income and you'll have some extra expenses, I think you'll be able to follow along just fine. Okay, so this is the form that you get when you are completing your regular income tax. You do your T1 general. So the area that you would record your business income, professional income, commission, farming, and fishing would be in this section of your T1 general. and you would record the gross amount and the net amount, but I will show you exactly where you would get those amounts from on the forms that we're going over, but just so you can see where you report your self-employment income on your T1 general. So with regards to the statement of business activities, this is the website. If you happen to lose the link, when you get the handouts, you will have the website in which you can pull the information down. They also have a fillable PDF. So that makes things a little easier for those of you who are doing it manually. At the end of the presentation, I will be providing you CRA approved programs that are free where you can do your income tax online, and they just ask you a number of questions and the forms get filled in. But I think it's very important to understand the statement of business activities or professional activities or farming activities, what the forms look like that you will be completing. There's also a guide that goes along with the forms that I just mentioned. This is a 113-page guide and will give you all the CRA details on what I'm presenting today. So I'm kind of giving you the general outline, but if you want to do a deeper dive into anything that I'm talking about, this 2020 version is the latest publication, and again, it does have the website. So when you're reporting as a self-employed sole proprietor or a partnership, you are going to report on a calendar year. So for your income reporting this round, you're going to be reporting for 2021. So those of you who have been in business for a full year in 2021, your start date would be January 1st. And your end date would be December 31st. Those of you who started your business sometime in 2021, for example, if you started your business June 2nd, that would be your start date for 2021. In 2022, you would claim January 1st as your start date. And again, the last day of business, or December 31st, is the last day of your business. So why this is important is the next section is we're going to be filling in some identification information, and that will be the part one of the statements that we've been talking about. So the first thing you'll do is you'll put your name in, so that's your personal name, and your social insurance number. Because as a sole proprietor or a partnership, you and your business are the same entity. So Canada Revenue Agency likes to connect your business to your personal statement in case for whatever reason they get separated. The next line is your business name. So this is the name that you have registered for your business with the province. The business number would be the number that you would get from CRA if you collect HST or payroll. If you don't collect HST at this time, or you don't have any employees, you may not have a business number, so you would just leave that blank. Your business address, obviously, city, province, postal code, and this is where they're asking you for when did you start your business, and or what date are you claiming from. So January 1st to December 31st is the fiscal period for your business. However, if you didn't start until May 3rd or June 6th or whatever, that would be your first date in the fiscal period to the end of the year. The next question was this your last year in business? Hopefully not, so you will check the no box. And then you'll identify your main product or service. So if you're a beekeeper, you'd put beekeeping. If you are a real estate agent, you'd put realtor. If you are a business advisor, you'd put business advisor. So whatever the main product or service is that you offer. And then they want you to use a industry code, and this is found in that guide, T002, the 113-page guide that I was talking about. And that information for that 6-digit code can be found on pages 106 to 109. So what you would do is just find the classification of business closest to what it is you're doing and use the industry code that they suggest. The accounting method that you're going to be using will be the accrual basis. However, farmers, fishers, and self-employed commission agents can use the cash method or the accrual method to report income. And all other self-employment income must be reported using the accrual method. So just to clarify the difference between accrual and the cash method, accrual would be you report the income based on your invoice date, and you would record your expense based on the date of the receipt or the invoice when you made the purchase. So you're using the actual dates. The invoice was for you, the revenue was generated, and the actual date you paid or made that purchase. The cash basis is, or the cash method is, when you receive money, that's when you would record the cash coming in. And when you pay a bill, you would record the cash going out. So that's the cash method. The accrual method is probably the better method. The reason being is when you're recording your income and expenses, you can truly see the month in which that revenue or that sale took place and the month that that expense was actually generated. In the cash method, you might get an invoice in March, but not pay it till April. So when you're analyzing your business, it doesn't give you a true story or a true picture on how money's flowing in and out of your business or how your sales are going. The next area is your tax shelter. So if you have a tax shelter, you'll enter the identification number. It will be on a T5013 slip. If you're not sure what a tax shelter is, you probably don't have one. And this is likely something you would have set up with your accountant. So for me, that's always blank, but you can go to the guide and find out a bit more information on that. Your partnership number would be, that's only for organizations or partnerships that have revenues and expenses that exceed $2 million in the physical period. So if anybody who has sales or expenses of more than $2 million, you really need to look into acquiring a T5013, and you'd be best to talk to an accountant about that. With regards to your percentage of partnership, for those of you who are in partnerships, you have likely discussed with your partner what the percentage split is. So it could be a 50-50, it could be a 60-40. So you would put your percentage of the partnership that you own. And then the last piece on part one is just the name and address of the person or firm who is preparing this form. So if it's yourself, obviously you just put your own name, and then if you have an accountant or somebody else doing it for you, they would put their name in there. The next section, which is part two, basically asks, do you have a website associated with your business where you would earn income? So if you do, you would put that website in here and what percentage of your business is generated through the internet. So quite often, if you're e-commerce, you would have 100% of your business generated through that. If you're a company that offers services, maybe only 10% or 15% or 25% actually comes from your website, and the other 75% say would come because you've sent out emails or made calls, or they heard about you through networking and that sort of thing. Also, if you sell on Etsy, eBay, Amazon, any auction sites, etc., you would also include those addresses there. So it's more for e-commerce businesses as opposed to service-related businesses. But if you generate money from your website, people get quotes and that sort of thing, and determined that make business or determined to do business with you, then you would put your website. It's always safer to put your website and not have it there. The other point I want to make is for those of you who have possibly more than one business, you would have to complete a complete form statement of business for each of these different businesses that you might have. So just know that if you have 3 businesses or 2 businesses, that's how many forms you would have to complete. So I'm just going to stop here for a minute and see if there's any questions. If you have any questions on anything I just went over, please pop them into the chat and I will definitely take a look. Okay, the next area that we're going to take a look at is reporting your business income. And as I said, if you're in farming, the way you report your income is a little different. They want to know the different areas that you're getting income from, but that's the only difference. So what we're going to take a look at right now is when you're recording your sales and revenues, you're going to have, and I've just made it done in quarters. So we have Q1, Q2, Q3, and Q4, and then a year to date. And this is an example of sales and an example for an organization who is collecting HST. And I see that there's a question, so I'm going to go to that and then come back to this slide. So the question is, I only started my website this year. Do I have to put it into this return? So the return that you're going to be filing for this year is for 2021. So if you started your website in 2022, you do not have to include it. Okay, going back to our revenue, I've put here just some definitions of returns, allowances, and discounts, because when we go to the next form, part 3A, it's going to mention returns, allowances, and discounts, and I just want to clarify what those are. So returns are if you had any merchandise that was brought back to you after the purchase, you may offer a return. So you would probably have a column that you would record any returns that you pay out within the year. Allowances are any amount you give to dissatisfied customers. So say you provided a service, they, got information that they were just not happy with it, but, they felt that you charged them too much for what you provided, then you might offer them, a 10% allowance because you weren't able to fulfill their expectations. So you would record any allowances that you might give to customers here. And then any discounts. So there are terms that some companies offer, 2%, 10, net 30. So you would invoice for a service possibly at $100 with 13% HST, but the terms are 2%, 10, net 30. And what that means is if they pay that invoice within 10 days, they can deduct 2% off the total. So you've already recorded the invoice at $113, but they may not pay that amount. They may have taken advantage of that 2%. So you would just put that little write-off of that discount in this column and then be able to complain or claim it on your income tax. The reason people offer 2%, 10, net 30 is just to help them with their cash flow. So instead of waiting 30 days, people can pay the invoice within 10 days, and it just helps the company a little better with their cash flow. So recording your business income, Part 3A, as I say, farming and fishing use different forms, and you'll be able to see they want you to break down where your income came from. But with regards to business or professional income, Part 3B would be professional income. But it's set up the same as this. So what they want you to do is record your gross sales, any commissions or fees, including HST collected or collectible. So if you recall, the example that we had here is we had $45,000 in sales, $5,850 in HST. So this is how we would record it. Line 3A, we would have the two added together. Line 3B, we would take out the HST, and on 3C, it shows the 45,000, which was actually our sales. Now, if you did have returns, allowances, and discounts, this is where you can subtract them off the total gross sales. If you didn't have any, then you wouldn't claim them. For those of you who are understanding the quick method of accounting, this is where you would record those calculations. The quick method of accounting is really only beneficial for companies that have a lot of goods that they turn around. So probably a retail location, you might want to take advantage of the quick method of applying the HST. It does have certain limitations, and if you're interested in finding out more about that, there is a guide that you can go to, and again, it's really good for businesses that purchase goods for resale. So if that sounds like you might want to look into that. The next area is Part 3C, and this is where we record a gross business or professional income. So some businesses might have some business income and some professional income, and you would put the total on line 8,000. I don't claim HST on my sales. I'm assuming I enter 0. That is correct. If you don't collect HST, then you wouldn't have any to deduct from your net sales. So we can also make some adjustments to our gross sales. If you had any reserves deducted the previous year, and if you go to the guide on page 56, it will explain allowable reserves. Most companies don't have them, but some might. So if you want to look into that, you can go to the guide. Other income would be if you received a grant, or you recovered a bad debt, or you won prizes through your business, you would have to claim the cash value of those prizes. So grants could be something like maybe some of you had taken advantage of Digital Main Street and maybe got a $2,500 grant to pay to help somebody help you with your social media and your website. So if you got grant money, you would record it here. Maybe you got grant money from Starter Company Plus, and you would record that there. So any grant money that you got for your business, this is where you would record that. And a bad debt would be, say in 2018, you did a sale, and maybe that person didn't pay you, and they said they weren't going to pay you, and you wrote that off as a bad debt in 2018, and miraculously 3 years later they decided to make good on that invoice and they paid you back that money, then you would have to record that as income. You would add all that together on line 8299. You would record the total, and in this example, it's $45,000. So remember on the T1 General, I showed you that you had to record your gross and net business amount. Well, this is the gross amount that you would put on that form, and here is what it would look like. So under business income, the gross amount right now is $45,000. The next part that we're going to take a look at on the form is part 3D, 4, and 5. And in these parts, you do not include the GST. So this is any GST that you have remitted as an input tax credit or has been claimed in HST or GST reporting. If you do not collect HST, you can include the HST in your expenses. But if you collect HST, the next section, you do not include any HST or GST that you paid on those expenses. So the first area we're going to take a look at is reporting cost of goods sold. So in this example, we start the first line on 3Q with our gross business income. In this example, it's $45,000. And then we record our opening inventory. So since we're a new business, our opening inventory is going to be 0. Throughout the year, we've probably made a number of purchases. So that could be purchases of products that we purchase to resell. It could be things like, say we made picnic tables and we purchased wood and nails and screws and paints and sandpaper and all that. We would record that on line 3S. Any direct wages that we paid employees to possibly build these picnic tables, we would claim those wages on line 3T. Subcontract is if you hired any subcontractors to build those picnic tables for you, you would claim that on line 3U. And then any other costs associated with your cost of goods sold, you would claim on 3V. You would add all those expenses up. In this example, it's $50,000, and that would be recorded on line 3W. At the end of the year, December 31st, you will want to do a closing inventory. So if you have a retail location, this would include any product on your shelves. If you made items, this would include raw materials, goods in process, or finished goods. In this example, we had $22,500 in closing inventory, so that would be at our cost. So our cost of goods for the year that we could deduct from our gross business income is $27,500, giving us a gross profit of $17,500 for the year. The amount that is on line 8,500, that would be our starting inventory that would go on line 3R for 2022. So whatever the closing inventory is from one year is the starting inventory value at the beginning of the next year. Any questions with regards to recording your income or claiming your income or cost of goods sold? Okay, so I have a question here. If receiving a loan with 0% interest with a partial grant 2 years apart, which year is the grant portion claimed as income in? The year you received it or the year the loan portion is paid back? So I am going to say you claim the grant portion the year you received it. So if you got a $10,000 grant over 2 years and you got $5,000 in 2021 and you're getting the rest of the $5,000 in 2022, you would only need to claim the $5,000. So you would claim it the year in which you actually received the money. The interest charged on the loan would be recorded somewhere else, and I will get to that shortly. A question here. So if I purchased a box of 25 tumblers and only sold 10 throughout the years, I still have 15 tumblers left. I would work out the cost of these tumblers less and put that on this line. That is correct. So if you had 15 tumblers, that would be your closing inventory. Again, if I don't answer your question fully, by all means, at the end of the session, we will have time for Q&A, so I can go into more details there if I wasn't quite clear enough for you. The next area we're going to take a look at is reporting our business expenses. So hopefully you've all taken the record-keeping course. If not, we do offer those. But with regards to claiming your expenses, I like to set up my books in accordance to how Canada Revenue Agency would like me to claim my net income or to claim my expenses. So when I'm claiming my expenses, my ledgers or where I'm recording my expenses are under these categories: advertising, meals and entertainment, bad debts, etc. So does anybody, I'll give you a chance to read through these different line items right down to motor vehicle. If there is any there that you're not quite sure what that expense is, just type it in the chat and I will explain it. If not, I'm just going to assume that you know the expenses that you can claim for your business. So I'll just give you a second to read through that list. And again, I'll go back to the chat if you want to type something in and I haven't seen it. Okay, so this is where you would record all your year to date, so all the expenses you have in these categories. Again, farming has a few extra categories, so they have things like containers and twine and fertilizers, pesticides, seeds and plants, feed, livestock. So they have a few more expense lines that they could claim in, but they would also have these expense lines. The motor vehicle expenses, not including capital cost allowance, and the capital cost allowance I am going to explain a bit later, and this is where you would record those amounts, but I will be showing this slide again just so you're clear as to where you would claim those. Okay, so on part 5, you're going to claim your net income or loss, depending on if you made money or didn't make money. And it's quite common for businesses in their first year to actually have a loss. And what you can do with the loss is you can go back 3 years and apply that loss to income you might have had 3 years previously. Or you might find that you want to apply it to income that you're going to be making over the next 7 years. So any losses can be applied to other years' income to put you in a lower tax bracket. So again, you might want to talk to an accountant. If you do have a loss, again, you can use that loss against income 3 years back and use that loss for income that you're going to make in the next 7 years. If you are a partnership, so say your income for the year was $15,000 and you and your partner have a 50-50 split, you would just claim 50% of your share of the income, and you would put that here. The next section is business use of home expense, and I'm going to be talking about that a few slides down. So while they're sort of in the beginning of the paperwork or the forms that you have to complete, it doesn't actually get explained till a bit later. So any other amounts deductible from your share of partnership. So what this is for those of you who are in a partnership and say you made some purchases and your partner and you agreed that no, we're not going to put that expense through the business, but you definitely paid for that expense and it is a business related expense. you can write off that 100%, provided you didn't put it through the business. So any expenses that you may have as a partnership that you didn't claim through the business, this is where you can deduct them from your income. The next area that we're going to go over is calculating the business use of home expense. And this is really nice for those of you who have offices or parts of your home that are set up for business purposes, so you can write off some of those expenses. So this is an example using from one of my previous income tax returns. So I would look at the heat I paid for the year, the electricity, the home insurance, any maintenance that I did. So what I could include on this line, if I had it, is say I put on a new roof, and that roof cost $20,000 to put on. I could put that on line 7D. Any mortgage interest I pay, any property taxes, or if you're renting, you could put other expenses, specify rent, and then you'd add that all up. What you would need to do next is determine what percentage of your floor square footage you're using for personal and what you're using for business. So in this example, we have, say, 800 square feet on the main floor, 800 square feet on the second floor. 200 of that 800 square feet I'm using solely for business purposes because I have an office set up in one of the bedrooms. That would represent 12.5% for business and 87.5% personal. So the personal portion I would put on line 7I, leaving 7J with my business use of home expense. And that would get put into the form where I had the arrow back a few where it said under expenses, it had business use of home expense. You would put that in there. The next area we're going to take a look at is calculating capital cost allowances. And there is some new rules, but I'm going to show you the old rules and then show you the new rules just so you're clear as to what they are. So you might acquire property such as buildings, furniture, or equipment for use in your self-employment activity. So this could be anything that you use that has a value of $500 or more would be considered a capital cost or an asset. And to be able to see what types of different capital cost allowances, on page 66 and 67, there's a number of different categories and classes and rates that you might use. So I'm going to show you a few of the more commonly used capital cost allowance classes. So class 1 is very common, and this is if you purchase buildings after 1987, you can write them off at a rate of 4%. Any property that you use in business that is not included in another class, say you purchased a storage unit or something like that, it would be a class 8. You would write that off at 20%. Any motor vehicles or passenger vehicles that you're bringing into the business, you would classify as a class 10 and be able to write those off at a rate of 30%. Any tools, medical and dental equipment, kitchen utensils that are $500 or more, so a stove or maybe a commercial blender, that would be a class 12, and you can write those off 100%. And then general purpose electronic data processing equipment, computer, software, hardware would be a class 50, and you can write those off at 55%. So where you would do this is under the capital cost allowance part, area A and area B. So for demonstration purposes, we're going to take a look at the equipment additions for the year. Let's say we purchased a work trailer, which is classified as class 10. The total cost, we'll say we paid $8,000. None of that is used for business purposes. So the business part is going to be the full $8,000. I'm now going to move that information up to area A. So column 1, I add the class number. Because this is the first year that we have this piece of equipment, there is no undepreciated capital cost for this item. So that would be 0 or left blank or not applicable. Any cost of additions for the year, which came from areas B and C below. Area C is for, let me just look here, buildings. If you had buildings, you could include them here, but we just have the work trailer. We don't need to worry about columns 4 and 5 right now. I'm going to explain those in a minute. Column 6 would be any amounts if we added any new items or if we disposed of any items. So say we had maybe a smaller trailer that we disposed of and got $2,000 for that, we would put that $2,000 in column 5 if we had it. But since we didn't, column 6 is the full $8,000. Again, 7 and 8 we'll talk about in a minute. And that leaves us with column 9. So because it is the first year that we're writing this asset off, or this capital cost allowance, we can only write off 50% of the value. So that's $4,000, so half of the $8,000, which would give us for column 10 a base amount that we could write off of $4,000. Again, for a class 10, we can depreciate it at a rate of 30%. So we would multiply the amount in column 11 by 10, giving us $1,200. So that's the amount that we can write off for that year. In column 13, it leaves us with $6,800. That is going to be the amount we're going to use in 2022 as our undepreciated capital cost at the start of the year, so column 2, and I'll just show you that. So if you can see here, 2021, we could write off 1,200, giving us a undepreciated capital cost allowance of 6,800. In 2022, we move that to column 2. And then we do our calculations based on that amount. And you can see column 12, in 2022, we can write off $2,040. So there are some new rules, and this is what they are. So the columns I said that we would talk about a bit later, column 4, 7, and 8 is where this information comes into play. So it's what's called an Accelerated Investment Initiative, or an AIIP, and it provides an enhanced first-year allowance for eligible property that is subject to CAA rules. So what you can do, and I will be showing you an example, is you can apply the prescribed CAA rate for the class of up to 1.5%. So I will show you the calculation. It's a very easy calculation. This is only going to be available till 2028. It is also going to suspend the existing half-year rules. So remember I said you can only claim half of the amount of the purchase. So it suspends that for a couple of years. So basically it allows you to write off more the first year than what you would normally be able to. And it's to encourage businesses to make purchases of capital cost items for their business. If you're a manufacturer or a processor, you can do full expensing, immediate write-off for the full cost of machinery and equipment used for the purchase of goods that are in class 53, and full expensing for clean energy investments, so electric cars and different write-offs if you're converting electric cars or using clean energy equipment, and that would be in classes 43.1 and 43.2. So you would have to look those up. So this is what it looks like, old rules versus the new rules, based on the work trailer example. So on the old rules, we can see the first year we could claim $1,200. The second year we could claim $2,040, giving us a total deductions for those 2 years of $3,240. With the new rules, we actually can write off $3,600 the first year. So that's a really nice write-off for the year because it lowers our income, so we don't have to pay taxes on that. And then year two, we can write off $1,320. So when you're comparing year to year, or comparing old to new rules, with the new rules, you actually get to deduct more in the first 2 years than you could with the other computation. So it's to our advantage if you bring in new assets or new capital items before 2028. I'm just going to show you how you would do this with a computer purchase, because Canada Revenue Agency is going to look at, you probably use your computer for personal reasons as well. If you had 2 computers and only used one for businesses, one for personal, you wouldn't need to break it down like this. But if you just have one computer, and let's say you use it 75% for business, this is how you would make that classification. So while the computer costs $2,000, you can only write off 75% for business, so that would be the $15,000. Again, using the old rules to new rules, the first year we can write off a lot more of that computer expense using the new rules than we can using the old rules. So it just helps us with the amount of income tax that we might have to pay the first year of business, and lowers that for you. Now, where you would claim that is on Part 4 under capital cost allowance. The amount for your capital cost allowance would go online for you. The last area we're going to take a look at is how you calculate your motor vehicle expenses. So hopefully you took a odometer reading at the January 1st or the first day of your business, and you took an odometer reading at December 31st, 2021. So what that's going to look like in this example is on line 1, we recorded the kilometers we traveled for business purposes, and we recorded on line 2 the total kilometers we traveled in that year. So again, we took an odometer reading January 1st or the first day of business. We took an odometer reading December 31st, the last day of business. And in this example, that was $25,000. In the meantime, we should be keeping a vehicle log. And the information that you should record in your vehicle log is the date you traveled for business purposes, the destination, so maybe London, Ontario, the reason for your trip. So maybe you were going to provide a service, do a seminar, deliver goods, and then the total number of kilometers. So again, the date, the total number of kilometers, the reason for the trip, and the destination. At the end of the year, you're going to add all your business-related kilometers and put them on line 1. And in this example, it was 20,000. So clearly this business does a lot of business travel in their vehicle and only uses a small portion of that for personal use. What you also need to do through the year is keep track of all your fuel and oil expenses, any interest if you have a loan, and you use the calculation in chart B below, which I'll show you in a minute. Your motor vehicle expenses, any insurance, any licenses or registrations, any maintenance or repairs that you made on that vehicle. If you lease the vehicle, you could add in some of those leasing costs. And if you have an electricity or zero emissions vehicle, you could write those expenses here. So in this example, the total expenses that we incurred for the year are $7,160. We use the formula. We divide our business use by the total kilometers for the year and multiply that by the total expenses, and that gives us $5,728, which we can write off as a business use of motor vehicle expense. So I mentioned there was a part B, and this is where if you have a loan or you're paying interest on a vehicle that you've purchased, you would calculate the total interest that you paid. In this case, it's $2,200. If for some reason you actually paid $5,000 in interest, you will put that there. And the allowable amount maximum that you can claim for interest is $10 times the number of days in the physical period for which you were charged interest. In this example, we're going to say it's 365. So if you had $5,000 in interest, you could only claim the $3,650, whichever is lower. But again, in this case, what we actually paid was lower, so that's what we can claim, the $2,200. If you have, if you're leasing a vehicle, there's different calculations, and you can claim a certain amount based on $35,000 max. So your vehicle lease might be for a vehicle that's, you know, $50,000, but you're only allowed to expense on $35,294. So you would have to figure out the calculation there. Once you've figured out your calculation, you would add that to Part 4 under motor vehicle expenses, not including capital cost allowance. So any capital cost allowance you're writing off for that vehicle would not be included here, but just the general expenses that we just talked about. So I mentioned that Canada Revenue Agency has a certified remittance software, and I highly recommend the 5th one down, Genutech Standard. I've been using this for years and years and years. I have 3 businesses, so it really helps to be able to do things computerized. Through this Genutech, I can actually do my income tax and my husband's income tax at the same time. It asks a series of questions for my G1 general, and then it asks me, am I self-employed? And I put yes. And then it starts asking me questions with regards to what we just went over. And it's just a series of questions that I answer. So it'll ask, what was your revenue? How much GST did you collect? Did you have any allowances or discounts? What were your expenses for advertising and service charges and all that? And all you do is type in the answers to the questions. And once you get to the end, it will show you what you have as taxable income for the year based on your G1 or T1 general and your T2125, so your business activity. So I really like that. It just asks questions. At the end, it asks you, do you feel you've claimed everything? Do you want to submit this automatically to Canada Revenue Agency? You hit yes. It submits it to Canada Revenue Agency, and then you can print out your T1 general with all the forms that you normally would submit, plus the one that you would submit, the statement of business or professional activities or farming if you are a farmer, and you can print all those out. So it's a really good program to be able to do your income tax online and not have to try to manually calculate all this information. These are some CRA websites and telephone numbers that you might be interested in. I really like the fact that you can set up an account with Canada Revenue Agency and go online and submit your HST, find out you know, where you are with your income tax, if you have a refund or if they've received your payment. If you have payroll, you can submit your payroll deductions online as well. So everything is done digitally now. You can still do it manually, but I really like the option of doing things digitally. So that's basically the information. We went over a lot, and I'm definitely open to answering any questions that you may have. So I'm going to stop the share now. I'm going to come back live. I'm going